Hello, all the CA into students. This is your CA Kaushik Mukesh, and today we are going to do a quick and summarized revision of all the formulae that are applicable for your financial management paper 6A. Okay, without any further ado, let us start with the formula revision of CA Inter FM. Listen to this lecture till the end. We will cover each and every significant formula that applies in your FM syllabus. Okay, let's begin. See, first I am starting with the cost of capital chapter. In cost of capital chapter, first formula is the KD. First formula is a KD formula. What is the KD formula? If it is irredeemable debt, it is a irredeemable debt. If it is a irredeemable debt, then the formula is I into 1 minus T whole divided by NP. This is the answer without a flotation cost. Whenever flotation cost is there, your net proceeds will reduce. So I into 1 minus T divided by net proceeds minus flotation cost. So this is the point one. Next, if it is a redeemable debt, what will happen if it is a redeemable debt? If it is a redeemable, there is a life. N component will come. So I into 1 minus T, interest after tax, plus RV minus NP by N. RV minus NP is a capital gain, divided by N is a per annum capital gain, whole divided by average price. Always remember, my dear students, in cost of capital chapter, RV redemption value is a sale value. NP net proceeds is a purchase price. Okay, means what? I will buy the debentures by paying money. Okay, by paying money means I am giving loan to the company. Listen carefully, I am a debenture holder. I am giving loan to the company. Company will give an acknowledgement called as a debenture. Okay, after 10 years, I will give back this debenture, means I will sell back this debenture, get back my money. Means in a debenture, in a bond always, today we will buy and finally at the end of 10th year or 5th year like that, we will sell. So buying and selling happen. But instead of calling it buying and selling, they call it NP and RV. RV happens after in future, NP happens today. Are you understanding the point or not? So therefore, we will be taking an average price of RV and NP. Since we are taking average in denominator, that formula becomes an approximate formula. Which formula? Approximate formula. Therefore, what we need to do? We must calculate IRR. We must calculate what here? IRR. What is IRR? Internal rate of return. How that will be done? You have seen already in my videos, or go back to the revision and complete. This is not a time to learn how to do. This is a time to understand only the formula. Okay. I don't want to waste time in discussing about other attached concepts to this. Okay. Let's continue. So I into 1 minus T by NP without flotation. If flotation costs are there, net proceeds or purchase price will be reduced by flotation cost. Simply from the company point of view, if you see, company receives NP because you will purchase at NP, company receives NP. So company receives NP. If flotation cost is there, NP will not be received by the company. NP minus FC will be received by the company. FC represents flotation cost. Okay, done. Next, from company point of view, see the same formula. Same logic is extremely the same. This is KD. This is KD, also called as YTM. Also called as what here? YTM. Always remember one thing. If a flotation cost is there, reduce it from NP. Okay, reduce it from NP. I into 1 minus T plus RV minus NP minus FC divided by N whole divided by RV plus NP minus FC divided by 2. This is with the flotation cost. Without with. Okay, next. Preference share. Irredeemable preference share. What is the formula for irredeemable? Life will not be there. PD by NP. PD by NP. Preference dividend divided by net proceeds. Okay. Without flotation. With flotation, NP minus FC. Next. Redeemable. Ditto. The only thing that changes between KD and KP is tax will not be there in KP. So tax component will not come here. Remaining everything is same. Flotation cost minus FC. Next. Equity. Calculation of KE. In this, there are so many models. Constant dividend model means without growth. Constant dividend model. I can write here. Without growth. Here also without growth. So first one and second one are without the growth. Next one, constant growth. D1 by instead of D, it will become D1. Instead of P, it becomes P naught. Growth also will get added and plus G will come. D1 expected dividend or dividend to be paid. How to calculate D1? D1 is calculated as D0 into 1 plus G. D0 into 1 plus G. So D0 means already paid dividend into growth. 1 plus G means compounded growth value will come. Okay. Next, how G will be calculated? G can be calculated in two ways. B into R. What is it? B into R. What is B? B represents retention proportion. B represents retention proportion. If you want, I can write here for you to understand. See here. B means retention proportion. Means how much you are retaining. Retention proportion. Retention proportion means, if you want that answer also, anyway in the chapter called as dividends, we will see this. Retention proportion means 1 minus payout. 1 minus payout. One minus payout proportion. What do you mean by payout proportion? Payout proportion means DPS by EPS. DPS by EPS. 5 rupee DPS, 10 rupee EPS. Payout is 50, retention 50. Understood the point now? That's how we need to understand. So, there are 5 formula in KE calculation. Number 1, constant dividend, D by P. Constant earnings, E by P. Constant growth, D1 by P naught plus G, E1 by P naught plus G. If there is flotation cost, P naught minus FC. P naught minus FC. Okay. Is the point. Next, realized yield, D1 plus P1 minus P naught whole divided by P naught into 100. Sir, what is the difference between this formula and this formula? Listen, I will explain. This is another way of representing this formula. Okay. D1 by P naught plus P1 minus P naught whole divided by P naught. Okay. That's why if you see here, P1 minus P naught whole divided by P naught into 100 is called as a growth. That is another way. B into R is one way. P1 minus P naught whole divided by P naught into 100 is another way of calculating the growth. So D1 by P naught is the first part of the formula. P1 by P naught, P1 minus P naught whole divided by P naught is another way of telling growth. So D1 by P naught plus GA will be also said like this. But when to use this, when to use this? In the question, if they have given retention proportion and return on equity formula, follow this. If they have given price after 1 year and price now, use this formula for growth calculation. Growth directly given, problem illa. Growth is not given. They have given retention proportion and return on equity. Go by B into R. They did not give G, they did not give retention proportion or return on equity, and but prices are given, then go by this formula. Understood the point clearly? So don't make mistakes in exam. Next one is the CAPM. K equal to RF plus beta into RM minus RF is the formula. Okay, next. Here, RM minus RF is called as market risk premium. Beta into RM minus RF is called as security risk premium. In the question, if they have given market risk premium, they have given RM minus RF. If they have given beta into RM minus RF value, security risk premium. Sometimes to confuse you, they will tell security risk premium 6.6%. Generally, people will mug up FM. What is the general trend? People think they are learning FM, but actually they are mugging up the concept. Risk premium they will remember. Whose risk premium they don't see. This is market risk premium. This is security risk premium. If they give security risk premium 6.6, you should not put it here. You should put it for this entire product Product of beta into RM minus RF is called as security risk premium. Okay. Next. Calculation of retained earnings. Generally, KE and KR both are same. Generally, KE and KR. If the comparison between old KE and KR both are same, that means all the aforesaid 5 models can be reused for reserves. Next, special case. If the comparison is between new issue KE and KR, see, I will give you like this. See here. Whenever KE is calculated, we assume that KE will be KR. Why? KE belongs to equity, reserves also belongs to equity. Okay. If two boxes of cash is there, okay, I said both belongs to you. How much return do you want? I will tell on this I want 20, on this I want 17. Like a fool, I will not tell like that. When both are belonging to me, I will ask same return on both of them. Clear? Now listen carefully. I will tell this way. This is your existing money. This money you have to raise newly from the market. Now I don't have. I have only one cash box. Second cash box should be newly raised from the market. When you newly raise from the market, costs also will get added to that or not. So new KE will be more than old KE. Simply listen like this. In the question given in exam, there is no new issue. KE, KR both are same. If there is new issue, then old KE will be KR. New KE you have to calculate as per the flotation cost and issue price. Understood? So, retained earnings are always used as current market prices. Tax in the formula represents personal tax. What is this? See, if question is given on KE and they have given flotation cost as a percentage, brokerage as a percentage, tax, personal tax of the investor as a percentage, then KR will be KE into 1 minus flotation cost into 1 minus brokerage into 1 minus tax. So KR will be always lesser than KE if the KE is a new issue KE. Understood? If you could not understand what I said, go back, listen again, you will understand. Next, how to calculate WACC, KO, using book value weights. KO means WD, KD, WP, KP, WE, KE, WR, KR. Means what? I have 100 rupees. Okay, 30 rupees I kept in KD. Means 30 by 100, 30% will be WD, weight of debt. I kept 20 rupees on preference. 20 by 100, 20% will be WP. Okay, so I kept 40 rupees in equity. 40 by 100, 40% is this. 10% is in the form of reserves. 10 by 100, 10% is the weight for reserves. So weight means proportion of total amount is called as a weight. KD, KP, KE, KR already we calculated now. Multiply them. You will get the book value weights. Sir, what is the difference between book value weight and market value weight? In a book value weight, I repeat again, in a book value weight, weights are there, na? Okay, these are calculated on the basis of book values. See, WD, what I said, totally 100 rupees capital is there. In that debt is 30 rupees. Well, what is this 100? What is this 100? Book value of total capital. What is this 30? Book value of debenture. But this 30 rupee debenture is having 40 rupee market price. This 100 total capital is having 140 rupees total value. Then you should not calculate debt value as 30 by 100. It becomes book value weight. You should calculate 40 by 140. That will become the market value weights of the debt. From that you should multiply this KD. If you did not understand what I said, this is a high time. At this time, you should not ask any doubt. This is a formula revision. Go back, listen what I said for 5-6 times. You will understand. Because I explained crisp, clear, and what is required for the exam. Next. Market value weights. KE will be KR. Okay, KE will be KR. So, if market value weights you are going to calculate, question la KE, KR both are same na, direct. WD, KD, WP, KP, WE, KE. Okay. Whenever, remember this, logic don't ask. Logic, go to the main classes and listen. This is a formula revision. Again, I am reminding for 4th time. Listen carefully what you have to do in exam. Whenever book value weights are given, are asked in the question, reserves will be considered. When market value weights are asked, reserves are not separately taken. Market price of a share is assumed to include already the reserves inside that. Means whenever market value weights are calculated, total capital is there na? Now I said, in that again reserves you should not consider. Market price of equity share law, already reserves are assumed to be included, and that assumption is absolutely right. Have any doubt? Go to my cost of capital revision lecture in YouTube, you will understand. I told there reason also why it came like that. Okay, this is formula revision. Again, fifth time I am repeating. KE equal to KR, directly you can do this way. Again, results will not come in market value weights. KE not equal to KR. KE not equal to KR means new KE is 18, old KE is 16. Old KE will be taken for the reserves. So 16 is the KR, 18 is the KE. Then what to do? Calculate market value of equity. I am only telling the steps. Logics, main video. Calculate market value of equity. Okay, calculated total market value of equity. Identify book value proportions. Okay, done. Book value proportions taken. Book value proportions are what? Book value proportion of equity and reserves. Market value is divided. Oh, market value is divided between equity and reserves in proportion to book value. Oh, now understood. Book value is 1 lakh. Market value of capital is 2 lakh. What we need to do? 2 lakh. You take. Branch it into two parts. Okay, branch it into two parts. What are the branching in two parts? Equity part, reserves part. Okay, book value weight of equity is 60%, reserves is 40. This 2 lakh should be divided into 2 lakh into 60 by 100, 40 by 100. 60 by 100 will go to equity, 40 by 100 will go to reserves. That's it. Do the problem, you will understand what I said. Okay, very, 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 very important is this note. If flotation cost is given in rupee terms, if flotation cost is given in rupee terms, we directly reduce it from issue price. Like FC we reduce it like that. If it is given in percentage, then two situations will arise. Question is silent, question mentioned to apply face value. If question is silent, on what you should apply flotation cost? On issue price you have to apply. Okay, if issue price is 100, on that issue price, the 2% or 3% or 4.5 something. Okay, if question mentioned to apply on face value, then only instead of issue price you will apply face value here. Understood? Like this you will do. With this, cost of capital formula revision is completed. Hopefully everyone understood all the points clearly. Yeah? These are the things you need to understand. Now you start doing the problem and revise. So the next chapter revision is capital structure theories. Here there are only 7 formulae which we need to understand. See here. First one, value of a company. Value of a company is B plus S. B means value of its borrowings, which is also called as a debt. S, value of its shareholders or shares, which is also called as equity. Value of debt and value of equity will become the value of company. Number 1. Number 2, value of debt. In this, the B answer, I by KD. I by KD. This is without tax. Next one, with the tax, I into 1 minus T by KD. This is with tax. Simple, yeah. B, I can also call it as NP. NP means net proceeds of a debenture. Cost of capital chapter formula type. So B is nothing but the net proceeds. The value at which you buy is called as a B. What we saw? KD equal to I into 1 minus T by NP. Correct? NP place la will put B. What will happen now? Interchange. B equal to I into 1 minus T by KD. That's how this formula came. Understood? That's it. Value of equity. Earnings available to equity shareholders divided by KE. Okay? Means you should understand one concept here. What is the concept that you need to understand? This chapter do not assume growth. That's why you will never see any growth here. And this chapter do not assume preference shares. So therefore, income statement, if you see, sales minus cost EBIT, variable fixed cost, everything, EBIT. EBIT minus interest, EBT. EBT minus tax, EAT. EAT minus preference dividend. All these things will be there, na? Those all will not be here. EBIT minus interest. Directly it will become earnings available to equity shareholder. Okay. So earnings available to equity shareholder divided by KE will become the value of equity, also called as S. Value of company. Value of company without tax, EBIT by KO. Because company belongs to two people. Company belongs to two people. Equity, debt. Okay. EBIT belongs to both. Equity, debt. EBIT by KO is the value of entire company. Okay. If tax is there, in that EBIT, tax will be taken by government. Balance belongs to both of them. So EBIT into 1 minus T by KO. When you calculate debt, denominator like KD. When you calculate equity, denominator like KE. When you calculate total, denominator like KO. Okay, next. Very important formula in this entire chapter. Value of a levered company. Value of a levered company equal to value of unlevered company plus borrowings into T. Logic, you can go and see the regular lectures. I told entire derivation for this formula. But as of now, remember, value of levered company equal to value of unlevered company plus borrowings into tax. Next, financial break-even point. What is a financial break-even? Level of EBIT means that at that EBIT, EPS becomes zero. EPS becomes zero. That's called as I plus PD into I plus PD divided by 1 minus T. Next, financial indifference point. Financial indifference point. What is financial indifference point? It is also EBIT only, but EPS under both the options will be same. What do you mean by both options? Which two options? Company with equity with debt, company without debt. Means only equity company or equity with debt or equity with preference. When you compare, we call it as a financial indifference. At that level of EBIT, EPS under both the options is same. Okay. Next, this chapter do not assume growth. This chapter do not assume preference shares. Completed. Next chapter. The next chapter is leverages. In leverages also, there are around 7 formula again. Okay. Let us see. First, operating leverage. Okay. Operating leverage. This can be of two types. If 1 year data is given, contribution by EBIT. If 2 year data is given on a comparison, percentage change in EBIT by percentage change in sales. Financial leverage. EBIT by EBIT minus interest. EBIT minus interest can also be called as EBT. So EBIT by EBT. One way. Or another way, percentage change in EPS by percentage change in EBIT. So operating leverage talks about business. Okay. Financial leverage talks about financing cost. Sales to EBIT, operating expenses. EBIT to EPS, financing expenses. Sales to EPS, both operating and financing expenses. Okay. So operating leverage talks about business risk. Financial leverage talks about finance risk. Combined leverage talk about total risk. So operating leverage talks about business risk. Financing leverage talks about finance risk. Combined leverage talks about total risk. Okay. Next, PV ratio. Contribution per unit by sales per unit, or total contribution by total sales. Okay. It will give you answer in terms of percentage. In terms of percentage. PV ratio is always a variable number. Is always a variable number. What do you mean by variable number? It will change according to the number of units. Okay. Sales change by 10%. Contribution also will change by 10% only. Okay. This is that much amount of volume of sales which is affected by the number of units sold, or simply it is that much amount of profit which get affected by units sold. Hey, easy way. Yeah. PV ratio is taking what and what? Contribution and sales. Below contribution, what will be there? Fixed cost. Fixed cost is irrespective of number of units produced. Whether you produce or not, you have to pay. So PV ratio is talking about what? PV ratio talks of that part of profit. Talks of that part of profit which is purely affected by volumes, which is purely affected by volumes. Volume means number of units. Sales changes by number of units. Variable cost changes by number of units. Contribution obviously changes by number of units. Fixed cost don't change by number of units. Irrespective of number of units, that will be same. So therefore, that part of profit which is dependent on volumes is called as profit volume ratio. Called as what here? Profit volume ratio. If you did not learn the concept this way, whatever you learned with respect to the concept of leverages is a wrong way. One way to tell that. Okay, so you should learn leverages in a right way to really appreciate CA final concepts on leverages. Again, this leverages concept will get reflected in portfolio management in CA final. Okay, so next, break even point. What point here? Break even point. Okay, break even point, what is the formula? Total fixed cost divided by contribution per unit. Contribution per unit. Or you will get the first one, na? BEP units into sale price. If you do, this will be answer in rupee terms. Okay, rupee terms. In rupee terms, in total. In rupee terms, in per unit. Okay, or fixed cost by PV ratio. Like that also you can do. Margin of safety. Margin of safety. Margin of safety is excess of EBIT over fixed cost. Excess of EBIT over fixed cost. Okay. So therefore, excess of EBIT over fixed cost means what? It is extra EBIT generated because of sales. That's why operating leverage vis-a-vis, this is not vis-a-vis, vis-a-vis means in relation to margin of safety. So operating leverage in relation to margin of safety, operating leverage equal to 1 by margin of safety, or margin of safety is 1 by operating leverage. Okay, this is one way. What is margin of safety? Actual sales minus break even sales, which is a profit sales. Simply that sales which started generating profit is called as margin of safety. Full details about this I have discussed in regular lectures. You can see there. Okay, next issue. Profit by contribution per unit or margin of safety units into sale price. Like that you can do. Here profit by PV ratio, here fixed cost by PV ratio. That's it. These are all various formula in the chapter leverages. So next chapter. So next chapter we are going to revise the formula is dividends chapter. Dividends law Walter model. Price of a share is D plus R by KE into E minus D whole divided by KE. D, dividend per share. R, rate return on investment, also called as a return on equity. KE, cost of equity. Price or cost at which you raised money. Cost at which you invested the raised money. E minus D, earnings minus dividend paid, retention. E minus D is retention. Okay. So D by KE, perpetual dividend. R by KE into E minus D whole divided by KE, perpetual retention value. Okay. So Walter model is a no growth model. Gordon model is a growth calculative model. One is without growth, one is with growth. So Gordon model, P naught equal to D1 by K minus G. D1 means what? D1 means a dividend to be paid. Dividend will be paid out of what? Earnings. Okay, out of what? Everything in the earnings will be paid. No, Whatever we retain, if you reduce from the total, balance is the payment. So 1 minus retention means balance is the payout. Earnings into payout will become the dividends. So KE minus B into R. B into R already cost of capital chapter we say on B retention proportion, R return on equity. Next, Modigliani Miller, 3 formulae, very important. P naught equal to D1 plus P1 whole divided by 1 plus KE. This is one formula. MP1, money to be raised by public offer. Recently I have done one revision lecture. There I told the logic of this formula also. You can see there if you don't have a clarity. MP1, okay, MP1. P1 means price after 1 year. M means number of shares to be issued. Number of shares into price means total value. How much amount we need to raise by public offer. Investment minus earnings minus existing shares into dividend to be paid. This will be the formula for money to be raised by public offer. I am explaining formula only. Logic everything. See the recent FM revision lecture I uploaded. Next, NP naught means today's wealth. P naught is today's price. NP naught means number of shares today. So this is the existing wealth. Okay. Existing wealth is P1 into N plus M minus I plus E whole divided by 1 plus KE. P1 into N plus M minus I plus E whole divided by 1 plus KE. P1 price after 1 year. N existing shares. M number of shares to be issued minus investment plus earnings whole divided by 1 plus K. Logic, see the video. This is formula revision. Gram and dot approach. This is not there now in the syllabus, no worry. Okay, next. Lindner's model. D1 equal to D0 plus EPS into payout ratio minus D0 into adjustment factor. D1, dividend to be paid. D0, already paid. EPS which is there into payout ratio. How much ratio you are paying? Minus already paid dividend into adjustment factor they will give. Some 10%, 40%, 50% like that. Miscellaneous, these are very important. If EPS is not given in the question, but BVPS is given. So question will come. Sir, what is BVPS? First, small note. BVPS. Book value per share. Okay, now let us understand one point. What is book value? What is book value? Book value is nothing but equity share capital plus reserves and surplus. At balance sheet value. What is the balance sheet? Balance sheet is a books of accounts. In that balance sheet, whatever equity share capital and reserves and surplus is there, that becomes book value per share. Okay. There is another meaning for equity plus reserves and surplus, also called as equity. Okay, also called as equity. Return on equity we tell na, return divided by equity. The equity means equity share capital plus reserves and surplus at balance sheet value. At what value? Balance sheet value. Okay, so return on equity means return divided by equity. BVPS means what? BVPS means divided by number of shares. Divided by number of shares. So equity share capital plus reserves and surplus divided by number of shares will become what? A BVPS. Okay. BVPS is also called as equity per share. Also called as what? Equity per share. Okay. This is a point. So BVPS into ROE. Question R is not given. Growth has to be calculated. B into R. B is given, R is not given, but EPS and BVPS is given. Then you can calculate ROE as a missing figure. These all ratios chapter are more important than here. PE, MPS by EPS. P by E means what? MPS by EPS. KE, D1 by P naught plus G. MPS, EPS into PE ratio. Okay, EPS into PE ratio. Nothing but C. PE is MPS by EPS. MPS means what? P into EPS. That's it. KE 1 by PE. PE 1 by K. Like that also you can calculate. These are all some important formulae in the chapter called as a dividends. Hopefully everyone understood the concept clearly. So with this we completed another chapter revision of formulae called as dividends chapter. Okay, let's move on to the next one. Next chapter is capital budgeting. Next chapter is what here? Capital budgeting. Okay, now see here. Capital budgeting formula revision. First, concept, accounting rate of return, ARR. Formula, original investment model, average investment model. If you are using original investment model, formula is average profit after tax by original investment into 100. Okay, remarks. Average, this is a second one. Average investment model, instead of average PAT, for average PAT only will be taken. Original investment instead will take average investment. What is average investment? Original investment minus salvage value divided by 2. Original investment minus salvage value. Recently I have made one capital budgeting lecture also. Okay, revision. If you want, you go to that and listen. I said very clearly about how these formulas came. Okay, this is only formula revision, not formula explanation and derivation. Listening, normal class like capital budgeting will take 65 hours. Here we have to cover in 6 minutes. Means you can understand the speed. So let us focus only on formula revision very fastly. So average investment means original investment minus salvage value divided by 2 plus salvage plus working capital. ARR uses profit after tax. And so if question gives cash flow, adjust it to profit after tax and compute ARR. How to calculate? Cash flow means profit plus depreciation. PAT means cash flow minus depreciation. Okay. Solve illustration 15, ARR. I have done clearly here. ARR is also called as accounting rate of return. Also called as book rate of return. Why it is called as book rate of return? Because in books means what? Accounts books. As per that return is calculated. That's why accounting or book rate of return. Next, payback period. Payback period is of 2 types. Annuity cash flow. Annuity means the same cash flow comes in 5 years or 6 years. Initial investment by annual cash flow. For uneven cash flow, cumulative cash flow and calculate. Do the problem, you can understand. This is not a formula, this is only a model. Okay. Next, discounted payback period. For annuity cash flow, instead of taking annual cash flow, we will take present value of annuity cash flows. Okay. Next, instead of taking cumulative cash flow, we will take cumulative discounted cash flows. You know how to discount now? Year cash flow, PV at the rate, PVCF, like that. If nothing is said in the question, these assumptions are important. See, question was given in exam. He did not say what to do, whether discounting payback or normal pay. He just asked calculate payback period. If nothing is said in the question, assume that normal PVP concept and not discounted PVP. Must do question illustration 15. Next, NPV, DISCI minus DISCO, discounted cash inflow minus discounted cash outflow. If profits are given, convert them into cash flow. Solve practical problem 1, 4, 5, 8, 13 and 18 in study material for understanding NPV. IRR. If annuity cash flows are given, means what? Same cash flow for 5, 6 years. DISCI equal to DISCO. IRR means a place where a rate where inflows and outflows discounted are matching together. Okay, whenever annuity cash flows are given, trial and error can be done using calculator directly. Illustration number 6. These are not formulas, these are models you have to do. EAB, EAC. If it is equated annuity benefits question, NPV by PVAF. If it is equated annuity card, DISCO by PVAF. PVAF is common. If it is benefit calculation, NPV you have to take in the numerator. If it is a cost calculation, DISCO by PVAF. Profitability index, DISCI by DISCO. Practical problem number 8. Here practical problem 6, illustration 14, illustration 7. Like that I have given. Just do that and complete. Capital budgeting formulas will not be there. Concepts will be there that you need to solve. Next chapter. Next one is working capital estimates chapter. Which one? Working capital estimates. In this chapter, I did not write formulas separately because the scattered formulas are there. Only 4 or 5 formulas, nothing great. So I will be covering in the question itself. See, raw material stock calculation you have to do. What one? Raw material stock formula. Annual consumption as a quantity into purchase price into raw material holding period. Raw material holding period divided by 365. Raw material holding period divided by 365. What it will give? It will give you raw material stock value. Raw material stock value. So raw material stock equal to annual consumption in quantity into purchase price into raw material holding period divided by 12 or 360, not 12 by 365, 12 or 365. Annual consumption as a quantity. Annual consumption as a quantity into purchase price. Raw material holding period divided by 12 or divided by 365 will give you raw material stock value. Next. You can also take it as material consumed into RMHP divided by 12 by 365. Next. Finished goods as a units. Annual production into finished goods holding period divided by 12. Remaining are not formulas, they just is a concept. Anyway, these formulas will come again in ratios chapter. I will go directly to next area called as cash management. In cash management, two very important formulae are there. One minute each. OTS, optimal transaction size. Recently, I have done a revision on working capital estimates. I kept in my YouTube channel. You can just go there and revise. Complete working capital estimates chapter in 6 or 5 hours. I completed everything. From the exam's point of view, don't take it for first time listening. Okay. Already, if you completed, that will be useful for you. Optimum transaction size. 2CT by I. C means annual cash requirement. Okay. T means transaction cost per transaction. I means interest cost divided by I. So this will give you OTS, optimum transaction size. Next one. There is another model called as Miller-Orr model. For this, there are some formulae. Let us see what are they. Upper bound, lower bound plus spread. Okay. RP, here I have given clearly. Return point equal to lower bound plus 1/3 of spread. Spread means what? 3 into this you have to mug up here. Okay. Logic, everything, regular class. Now mug up the formula. If they give, you have to write 3 into 3 cube of 3 by 4 into TC into CFV, cash flow variance per day, divided by interest per day. 3 into cube root of 3/4 of transaction cost into cash flow variance divided by interest per day. That's it. These are the two formulae here. Nothing great. We are going into the final chapter, ratios. Okay, which chapter here? Ratios. See, ratios, so many formulas are there. I compiled the most important out of all. Means if you prepare those, you need not prepare any other thing except these. Okay, like that I prepared some most important formula in ratios. See, there are 6 segments in ratios. Liquidity ratio, capital structure ratio, activity ratio, sales profitability, capital profitability, miscellaneous. Okay, let us see one by one. First one, liquidity ratios. Which one? Liquidity ratio. Current ratio, current assets by current liabilities. Liquid ratio, liquid assets by current liabilities. What is a liquid ratio? Liquid asset, current assets minus stock, minus prepaid expenses. Because liquid assets we will not consider stock. Reason is what? Stock should get converted into debtors. Debtors should get converted into cash. Time is more taken here. So therefore, it is not easily liquidated. Clear? So liquid assets, stock and prepaid expenses won't come. Next. Capital structure ratios. Okay. Capital structure, go to liability side first. Debt by equity, debt equity ratio. Very important, and students make mistakes in this area. So debt means what? Preference shares also will be taken as a debt. Is a question. Listen. Normally debt equity ratio calculation, debt represent only debt. Preference is treated as equity only. That's why preferential capital is deemed as equity. Debt means only long-term debt. Clear? Equity means share capital, reserves and surplus minus miscellaneous expenses. Okay? Means share capital means equity and preference, both will be taken. Equity also known as a net worth, shareholder fund, proprietor fund, anything they can call. Okay? So debt equity ratio if given in exam, preference is a equity there. Sir, when preference also will become debt, it becomes when you are calculating similar kind called as capital gearing ratio. See, capital gearing ratio, debt plus preference by equity, now here debt is separated, preference also separated. In this case, equity preference will not come. Gearing means leverage. See, debt or logic's okay. Equity here does not represent preference share capital. It is also treated as debt only. Okay. So next, propriety ratio. Propriety means what? My own fund, equity divided by total assets. Equity means equity, preference and reserves. See, normally equity means equity share capital, preference share capital also, except when you are calculating capital gearing ratio. Next, debt service coverage ratio, EBI DTA divided by interest plus installment. Next, activity ratio. Which one? Activity. Okay. Capital turnover ratio. See, all kinds of activity ratios. Okay. See, I will show you one thing. This is profitability. Miscellaneous. Activity ratios, also called as turnover ratios. Also called as what ratios here? Turnover ratios. Okay. Now, see here, I will explain one point here. Activity ratios are also called as turnover ratios. Also called as turnover ratios. Whenever I call turnover ratio, turnover is in numerator. Okay. Capital turnover ratio. Turnover by capital employed. Capital employed in our business. Therefore, in the capital employed, any investment made in other company should be excluded. Fixed assets turnover. Turnover by fixed assets. Turnover means sales by fixed assets. Working capital turnover. Sales by working capital. Debtors by turnover. Sales by debtors. Or sales by average debtor. Or if you want the answer in days, not in amount. Okay. Debtors turnover ratio you want in days, number of days. Debtors into 360 by sales. Debtors into 360 by sales. Sir, what does it mean? Total debtors by total sales. Total debtor by total sales. You will get 1 day debtor on sale. 360 total debtors will come. So debtors turnover ratio. This is not a logic time. This is a formula revision time. So I'm not going much into that and wasting your time. So I hope everyone is listening at the neck of the moment. At this time, you should not ask logics. Logics already you should have completed. So capital turnover, turnover by capital employed. Fixed asset turnover, turnover by fixed asset. Working capital by fixed assets. Turnover by working capital. Okay, turnover means here sales turnover. Debtors, sales by debtors or sales by average debtor or debtor by sales into 360. Which one to apply? If 2 years debtors are available, go for average or else go by this. If days are asked, then go by this. Stock turnover ratio. From here, very important. Whenever stock turnover ratio is given, question whether cost of goods sold is available or whether you can calculate or not. You see, most of the problems we have to do cost of goods sold calculation. Okay, cost of goods sold calculation. Instead of writing sales, write down cost of goods sold divided by stock or average stock. Same like this. Debtors by sales, it is stock by sales or average stock by sales. Creditors, same concept again. Next, profitability ratio. Profitability. All these are profits. Gross profit, net profit, total profit. Gross profit ratio. Gross profit by sales. Here sales will come on denominator. Net profit by sales. Operating profit, EBIT by sales. Cost of goods sold to sales. Cost of goods sold. Return on capital employed. Return divided by capital employed. Capital is employed by whom and whom? Equity and debt. Debt want interest. Equity want profit after tax. So profit after tax plus interest divided by capital employed. Return on equity, only equity. Equity shareholders want PAT. Equity is in denominator. Next. Earnings per share, earning by number of shares. Dividend per share, dividend by number of shares. MPS, market value by number of shares. Okay, next. Dividend payout ratio, DPS by EPS. Already I told all these formulas. That's it. With this, we completed a very, very quick revision on all the formulae applicable for CA Inter FM. Please go through this video before you go to exam. All the formulas have been thoroughly covered in this. Okay. All the very best. Okay. If you are really enjoying this particular concept, this particular class, please click a like, share it to your friends. It will be useful for most of them. And please also tell your friends about the revision that we are doing, such that most beneficial persons will be your friends. Okay. Thank you very much. All the very best. See you in CA final AFM classes.